Okay, now when we are talking about short-term intraday, I'm not talking about like 1 minute chart, 5-minute chart. Okay, as a retail trader, it's very difficult for you to actually make money from those time frame. Okay, because of the spread issue. Okay, to give you the understanding of how that's going to affect your trade, right? Okay, now I want you to understand that if let's say dollar yen here, you know, a typical broker, you can get it with a spread of let's say 1 pip. Okay, now there are some who can give you a spread of let's say 0. maybe 1 pip. Okay, but they do come with let's say $7 commission per lot, per round lot, right? Which means you go in, you get out, that's about $7. Okay, now if you actually, you know, take a look at that, they are more or less similar, right? Because you know, if we let's say we play around with this to give you some understanding of this also. Okay, because a lot of people just look at spread. Okay, but it's not the entire picture, right? Because if the broker gives you such a low spread, usually it comes with a comms. On average, the industry here is about maybe 5 to 7, some might be higher, right? So $5 to $7 per round lot. And what does that translate to, right? Let me share with you. Now, if you trade one lot, typically 1 pip value is about $10, right? Give and take. Different currencies, slightly different. But for simple math, we just do it like that, right? So if today you have, let's say, a spread of 1 pip, that cost over here, we're gonna be $10, right? Okay, because that's the spread of it. Okay, but this $10, okay, I want you to understand is this $10 does not eat into your profits. Okay, it's just the difference between your entry and your exit price. Okay, which means that if today you want to make 10 pips of profit, net profit, and the spread is 1 pip, you need the market to move 11 pips for you to profit a net $10. But when you make that profit, you pocket the full $10. Okay, now if you are looking at like spread very low plus a $7 commission, okay, that $7 is extracted out of your profit. Okay, so for example, okay, let's say the market moved 11 pips. Okay, so you have a spread of 1 pips, then this here, option A, okay, you make a net profit of $100. Okay, 1 pip, $10. You net make 10 pips. That's a net profit of $100. Okay, so the option B, okay, the difference here, of course, is that your spread, which is 0.1, so your net spread profit is gonna be 10.9 pips, okay, which translate to $109. Okay, however, because you have a $7 commission, you need to minus off, okay, that $7 of commission, okay, and that translates to you are making a net profit of 102. Okay, so that's why I say it's more or less equal, right? Because you can see over here, if you are looking at typical 1 pip spread, your net profit is $100. Okay, with a very low spread, but you have a fixed commission, you're making about 102. More or less similar, right? Okay, so that's the idea behind it. Now, why I want to talk about this principle here is because I want you to see, right? If today the typical spread on some of the common currency here, we'll just put it as 1 pip, right? Because even with like 0.1, you add in the commission, the cost is roughly towards 1 pip also. Okay, so now let's just make things simple and let's say average spread throughout is 1 pip. Okay, now if today you are trading on, let's say, a 1 minute to 5 minute time frame chart, okay, and let's say you're so small in that time frame in such a way that your SL range, okay, your stop loss range is, let's say, about maybe 10 pips. Okay, and let's say your take profit range is somewhere around there, right? 10 to 15 pips. Okay, or maybe I will just play around with it a little bit, you know, to play around with the risk to reward. Maybe your stop loss is 8 pip and your take profit is about 10 pips, right? To make numbers nicer. Okay, Now I want you to see, right, if that is your setting of most of the trade, okay, over here on the right, and your spread typically is about on average 1 pip. Okay, in percentage terms, I want you to see, okay, 1 pip out of 10 pips in your profit, that's actually a 10%. Okay, in other words, if you're looking at so small time frame and you're looking to profit off from it, you're paying the market because of the spread 10% of your profit. Okay, and of course, if you put that into your stop loss range, it's about 10% as well, which means even before the market start moving, once you execute the trade, you have the spread inside that, right? You need to account for that. Immediately, you take out 10% of whatever you decide to do. Okay, so that's huge, right? But if you compare that to, let's say I'm trading, okay, let's say another trader, right? I'm trading more of like a higher time frame. Let's say maybe 1 hour to 4 hour time frame, right? And my range here starts to increase. Let's say this becomes like 30 bits, right? And then my TP, let's say here increases to 50, okay, or maybe to make things easier, 100, okay. So 1 pip of spread out of 100 pips is only 1%. Okay, so can you see that, right? That's the difference where I think a lot of traders might not fully understand why it's not in your advantage to go too low a time frame and try and scalp the market. Okay, because from time to time I still receive questions like people asking, can I scalp the market? Okay, I'm not saying cannot, but you realize that it's slightly more difficult to do and make money, okay, because you're paying so high versus someone who is on a larger time frame and just paying that 1%. Okay, it's different story if you go into a prop firm because they have that volume, they have the advantage to kind of like negotiate with their liquidity provider. They are able to drop their spread very, very low and there's no commission, right? If you're looking at retail brokers, they need to make money. Okay, they can't just give you so low spread. Then how do they sustain their business, right? They need to add in the commission level. Okay. So I just want you to understand that, right? From a retail trader perspective, it's not to your advantage to trade on like 1 minute and 5 minute chart. Okay, now some traders do that and still are able to profit from it. But then your precision level needs to be super high, which means that once you enter the market, you can't really tank through any drawdown, right? Because of the spread. Okay, so I hope you understand from this.